Now we move on to the second reading. How do firms manage financial risk? Again, it's a continuation of the previous reading. It's simple, nothing to worry about. Small basic terms will be introduced and some things will be repeated. The first one is the strategies for risk management. Like I said, the four: accept, retain, which is retain, or you can avoid the risk entirely, or mitigate the risk, or transfer the risk. So let's see each one in detail. So why will a firm want to accept the risk? That is, like I said, they want to gain that return. They expect a higher level of return, so they are taking a higher level of risk. That is, they desire the exposure. The second point is that cost to manage is greater than benefit from managing. So what happens is that if you're managing the risk, there is a huge cost because you need to develop systems, you need to hire managers. But in some cases, it is more judicious to let the risk be because the cost of managing is much higher than the benefit you would gain from hedging or managing that risk. The third point is that if the product is price elastic, then the cost can be transferred to customers. So people, let's say if there were only two or three banks, very few banks, and they colluded and they offered interest at very high rates. So in that case, if there was an increase in risk, the banks would not worry. Banks would just increase their interest rates even further, so that the risk, the 3%, like I had explained in the previous reading, the 3% expected loss, they would transfer that three risk of that 3% defaulting on the other 97% by charging them higher interest. That's all in accept. The second one is avoid. That is, you don't take that risk entirely, and it is very judicious in some cases as well, because what happened in before 2007-9 was that huge conglomerates like General Electric and others, they became greedy and they entered into financial lines of business which they were not originally in, seeing the boom in these industries, and ultimately these divisions failed and some of these companies also closed down. General Electric didn't, but they would have had they been more deeply engrossed in this aspect of the financial world, which they shouldn't have. And they should have. What I mean is that they should have focused on their original lines of business itself. The third one is to mitigate the risk. So there are a number of different methods. Like I said, you give loans to a few people, or you charge a little higher interest so that the 3% is hedged from a higher interest on the 97%, or you may ask for higher collateral. For example, if you default your house, I will take over your house, the bank will take over your house. So you charge a higher collateral. That is, you say, I need a higher value of this house, or I need more property or other valuable things that I may confiscate or whatever. The next one is transferring the risk. Again, insurance. You take an insurance. There is a cost benefit analysis in that as well. That the premiums or insurance that you're paying, is it worth the benefit that you will derive if a risky situation arises? The next one talks about the relationship between risk appetite and firm's risk management decision. So, what is risk appetite? It talks about how much risk you should take. So, let's see this one first. So, the bank calculates that it can take 200 million of risk, the total risk capacity. So, let's say you can eat two whole pizzas. That is your risk capacity, 200 million or two whole pizzas. But you know that if you eat two whole pizzas, you will puke. So the bank also knows that if it takes 200 million full risk, they will be in a situation where they might fail. So they set their risk appetite. They tell the employees, no, our risk appetite is 170 million. You tell your friend that, no, I can't eat two pizzas. I can eat a maximum one whole pizza. Okay. In an extreme situation, but you don't go and eat one whole pizza every day. In reality, you eat half a pizza. Basically, you take a large pizza and you share it with someone, half and half. So you eat half a pizza. So same thing over here. The actual risk accepted is 150 million, and this risk appetite is 170 million, which needs to be identified, mapped using the different risks. You need to operationalize the risk appetite, which is you need to understand how it might impact your firm, and you need to take appropriate risks. So, like again, the biggest risk is not taking risk. So you need to take enough risk of 150 or so million. Like if you're taking only 50 million, then you're losing out. The bank is losing out if you're taking only 50 million worth of risk. The fourth is to implement a plan which we had done earlier as well, and then fifth is you need to keep monitoring the plan and keep updating it. So we move to the role of the board of directors. What they do is that they qualitatively state which risk the firm wants to retain, and which risk the firm wants to avoid, mitigate, transfer, etc. And they use quantitative metrics such as value at risk, expected shortfall, to convey the maximum amount of risk that the manager should take. And lastly, they use qualitative variables such as stress testing and scenario analysis, which we had done earlier. So now there is a conflict of interest between debt holders and shareholders, because the return for shareholders is not fixed. The more risk the firm takes, there is a possibility of higher returns. So shareholders want a higher risk taking management. But debt holders, on the other hand, their returns are fixed. That is, they'll get only a specific amount of interest and they don't care about how much risk the firm takes. So they will want to take less risk as possible. On the other hand, the shareholders want to take as high risk as possible. So there's a constant tussle between the two, and there needs to be a balance between the two. You can't take too less risk, too low risk, otherwise you won't earn enough return, and you can't take too high risk, otherwise your firm might fail. So there are several complexities that the board may need to consider depending on the unique circumstances of each firm. And you can just read through. There is the unity of risk appetite, that is, there are different divisions and different types of risk, and different firms can take different quantities of the different types of risk, and different divisions also can take different quantity. So there needs to be an enterprise wide framework where everything should be unified. The second is entrepreneurial opportunities. So if there are two projects available, you need to consider which is better on a risk adjusted basis. The third is layers of correlated risk. So the problem is that sometimes banks don't realize the amount of risk present due to correlation, because there are different layers of correlations present. One is correlated with the other, one is three are intercorrelated, etc. And there are hundreds of such variables. And then to calculate, there would be 100 C2 correlations, which is over 5,000 or so. Next one is the time horizon. So would the board want to hedge the short-term risks or the long-term risk first? If it hedges the long-term risk, it might default over the short-term. Or if it goes on to smooth their operations in the short-term by hedging their risk, there might be a long-term scenario that they are missing out on. And you can read the rest, it's pretty easy. The next is risk mapping. So you need to assemble an inventory of all known risks and you need to map them. How much each risk will impact which division, how will they map, how will they affect your organization, etc. You need to consider correlation and netting. Netting is basically 10 and 5 make less than 15. That would be netting. And correlation is 10 and 5 make less than 15 or greater than 15 or equal to 15. Usually netting works to reduce the risk between two divisions. So you can just read through. There's nothing for me to explain in this part. So the next one is hedging. So what is hedging basically is that, let's say you have a stock and you expect that now it will fall, but you don't want to sell it right now. So there are instruments wherein what you do is you pay a fixed amount. Let's say you have a stock worth $100 and you're expecting that its price will fall. So what you say is that you pay someone, let's say $5, and you say that whatever amount it goes down, you have to give me that amount. It's called a call option. It's called a put option. And if you buy that, the whatever value by whatever amount the stock falls down, you will get it. And by whatever amount the stock goes up, you won't have to pay that. So that's good for you. So if it goes up, you only lose that $5 which you gave them initially. And if, for example, the stock goes to 110, so you've gained $5 net because your stock has gone up by 10, but you've paid that 5 to that person. Or if the stock falls below 100, so let's say it fell to 90, So you've only lost the 5 which you had given them for insurance. You're not losing the 10 entire amount. So that's something to consider. So that's one form of hedging. So there are advantages, disadvantages. We'll study that. Hedging advantages in practice, it lowers the cost of capital. So how it does this is that if you're hedging your risks, this means your risk has gone down, which means your credit worthiness has gone up. So you can take a loan or take on more debt at a lower level of interest since your credit worthiness is high. As simple as that. And the other points are repetitive. It increases debt capacity, obviously, because you're getting interest loans at a lower rate. The third one, fewer conditions on those loans. Since your credit worthiness is high, there won't be too much conditions or collateral requirements, etc. on those loans. Second one is a potential cash flow advantage. So there might be a huge profit in that hedged position that you take, but usually this hedge position gets offset with your original position. The second one is that it smooths out revenues, costs, and decreases tax liability. For example, you had a you're expecting to realize a huge 100 million of profit in this year, but on average you don't realize that higher profit in all years. Let's say it's only 30 million. So this year it's coming up to 100 million profit, and you don't want to pay that high higher tax slab rate on $100 million. So what you do is you take some form of hedging instrument and you the revenue from that distribute that profit to the next year. In some way, we'll study about all the hedging instruments and the products later on and understand. So what you do is you take 40 million and you send it to the next year. So it becomes 60 million this year and 30 plus 40, 70 million this year, and your tax burden goes down. Similarly, what it does is smooths out revenues. Again, it becomes 60, 70 rather than 130. And then the third point talks about it stability in a firm's operation signals strength to its stakeholders. So if the firm stakeholders see that you're earning 100, then your next year you're earning only 30. So it might be a warning bell for them that your profit has fallen down by 70%, which is huge. So what again that 60 and 70 helps. The second one is communicates the risk appetite established by the firm's board of directors. So since you're taking lower risk by hedging your risks, you're reducing your risk burden, you're mitigating your risk burden. It communicates that you don't want to take excessively high risks, and it is communicated to all the stakeholders. The fourth one is that management sees hedging as having two distinct benefits, which is making the business planning easier. So once the risks are controlled, the management is not afraid of the these small aspects, and the management can move on to taking bigger decisions that might take the firm to great levels. And the second one is that there is no crutch to meet short-term performance goals. So, sorry, hedging can be used as crutch to meet short-term performance goals. So, let's say other way around. This year you're earning only 30. The next year you expect to realize 100. So you can bring that 40 from that forward to this year and make it 70 and 60 in some way. We'll study about that later. And the last one is that there are derivative instruments that may be cheaper than insurance policies, which we'll study about later. Hedging disadvantages in theory. So the crux of this is that it assumes capital markets are perfect, which is impractical. What this means is that it assumes that all securities are infinitely divisible. That is, you can buy 0.00001 of a security, which is usually not allowed in most countries. Firstly, second one is that there are no transaction costs and fees. The third one is that investors are rational, which they are usually not. And there are other assumptions of capital markets, which we'll study in capital asset pricing model. So this is the crux of it, that it takes on impractical assumptions. So which is why we say that hedging is not always perfect, but it is beneficial to some extent. Hedging disadvantages in practice. This talks about that there are unplanned costs. So some like we spoke about earlier, that there are costs and benefits to managing risk. So some firms don't realize that the huge cost that is inherent in the risk management process or in some hedging instrument. They don't know the amount of risk they are taking on. So that is an unplanned cost for them. Second one is compliance expenses. So if you're entering into the financial business, there are a lot of compliances, disclosure requirements, monitoring that you'll have to do, which is again a burden. The next is that there is a huge amount of leverage built into derivative products. You won't realize when it wipes you out completely. Firms, this has happened to firms. They have failed to recognize the inherent risks in these leverage products, and you should take as low leverage as possible in life. That would be my recommendation. Then the next one is that pricing may not always be as accurate as possible. So there are some derivative products, specialized products, which are priced usually incorrectly by the market because markets are not entirely efficient in those aspects, and they lead to a huge problem for the firms which are buying these products from more knowledgeable people. So now, again, the challenges involved with hedging strategies. It's a little repetitive of the disadvantages, but we'll have to study it. Obviously, the firm might misunderstand the risk exposure, that it might hedge the wrong risk. A second one is that the market trends change. So, for example, you've hedged the downside risk by buying that put option I told you on your $100 stock. But what if your stock keeps rising to a huge extent, and then you might be sad that why did I hedge this risk? The third is that the potential for problems to be amplified by poor communication. So we'll study an example about this in one of the chapters later. The MGRM example, you'll understand that better over there. And the last one is that hedging often requires very specific skills, knowledge, research, and time. Obviously, because hedging is not easy, financial managers are required for the same, and you cannot just go in and buy a derivative structured product. It's easier now to buy call options or futures on your stocks, but there are a lot of different products that we'll study about earlier, which is very difficult to understand. Okay, let's move on to the next module, the next learning outcome, which talks about the appropriate methods to hedge different types of risk. It's pretty simple. I think you should go through it yourself. If you have any questions, you can ask me. It's pretty simple. Pricing risk, foreign currency risk, interest rate risk. It is just a continuation of the market risk, like I had taught you in the previous reading. It talks about the risk inherent in these things again. The fourth, the static and dynamic hedging strategy, is that let's say you took a hedging position on an instrument and the market trends have reversed. So now you have to reverse that position, or the market trends have even worsened. So you need to take another position, and you need to constantly update the hedging position. That is called dynamic hedging. Dynamic means constantly changing, obviously. So you need to keep changing that position. But that again entails a huge cost, transaction cost, manager fees, etc. So you need to consider the cost benefit analysis in that aspect, or you may go for a static hedging that you put it in place and you leave it there. That's all. So this next learning outcome talks about the impact of risk management tools. Let's go through this table first. The first one is stop loss limit. So let's say you bought a stock for 100 and you entered a stop loss of 90, which means that as soon as the stock price goes down to 90, your position will be squared off. That stock will be sold so that you do not incur any further losses. But there might be one case, you need to know this, that the stock might go from, let's say, 91 directly to 85. So it'll not get sold at 90. Your stock will get sold at 85 or even lower. So that is something that you need to consider. The second one is notional limit. So for this, I need to explain to you something that is called swaps. So let's say I want to take on the interest of a particular product. Let's say you give me treasury bond returns for the next 2 years, and I will give you 2% fixed. Okay. So why will we do that? Because I expect the treasury bond returns to rise, and you expect the treasury bond returns to fall. So the treasury bond returns keep fluctuating. So let's say today is 2%. So I say I'll give you 2% fixed, and you give me whatever is the treasury bond return. So if it goes above 2%, it is my benefit, and if it goes below 2%, you are at a benefit. So on what amount does this 2% and that treasury bond return, whatever percent, fall on? That is called a notional limit. Let's say the notional amount, because it's called notional because that actual, let's say $100 million figure on which 2 million or and whatever your amount is, it is exchanged. So that 100 million is never actually exchanged. That is called notional, and there might be a limit on that amount on certain managers, certain divisions, etc. Third is risk specific limits. Very simple. You can't take more than this much of this type of risk, market liquidity, etc. The fourth is maturity or gap limits. So you cannot have too many loans. Banks cannot have too many loans. Sorry, the banks cannot have too many fixed deposits. The deposits to them maturing at the same time, because a huge payout pressure will be built upon them at that time, and they might not be able to provision for that. So the banks have to create a maturity limit for that. Next one is concentration limit. So I cannot keep giving loans to the same person. I cannot keep giving hundreds of millions of loans to the same person or entity or whatever. There needs to be a limit, a concentration limit. That is, my risk cannot be concentrated in that one entity or in that one division or in that one industry, so to say. So there are limits for that. Next is Greek limits. You'll study about Greeks when you study options. Next one is VR. So you need to fix a value at risk. Obviously, very easy. Next, scenario analysis, stress testing. That is also a measure of way of limiting your risk by having enough economic capital with you. Okay, so let's move on to the different types of derivative products. The first one is forward contracts. So let's say stock is trading at 950 currently. I tell you, I'll sell it to you after 1 month for $1,000. So why the difference? Obviously, because time is money. $950 today is not time. $950 a month later, I'll put it in the bank. I might get more. I'll hopefully get more than 950, and there is risk involved as well. So you need to consider that. So that is a forward contract. Futures contract is different in the sense that it is institutionalized. It is on an exchange. I can trade futures with hundreds of thousands of people. Swap contract, like I just explained to you, it's pretty simple. That was the simplest kind of plain vanilla interest rate swap. There are many different types of swap: forex swap, currency swap, total return swap, overnight index swap. No need to worry about all that. We'll study everything. Next one are options, different types of options. We'll study everything. So this point over here, which talks about basis risk, you need to know this. This is important. What it means is that, let's say you have to buy a product on 15th May, but and today is 1st April, you have to buy a product on 15th May. But the futures contracts are only available for the end of the month. So it's either 30th April or 31st May. And you need to hedge your price risk because the prices might go up very high and you don't want to pay that very high price on 15th May. So you take a contract obviously till 30th of April, and then you bear that risk for 15 days. You have to bear that risk. There is no other way out usually. So that is basis risk. There is one type of basis risk. The other type of basis risk might be the simplest example that you'll read is that airline companies. So usually there are no products available to hedge their jet fuel risk. There are products available to hedge the crude oil risk, but not jet fuel. And even if there were, airline companies won't want to take the risk of that on because there will be no counterparty in case of a crisis. Or only all aviation companies will use jet fuel usually. And if there's a crisis in the aviation industry, who will be the counterparty to them? No one. So they would prefer to trade in crude oil futures and forward contracts rather than trading in jet fuel. So the difference between the price of a crude oil and jet fuel, it might divulge, and they will have to bear that risk. They can't do anything about that usually. That is another type of basis. This is the simplest example, and that's what they've written over here in this next paragraph. So that was this reading. Again, pretty simple. No need to worry. We'll move on to the next reading now.